When trusts incur losses, they cannot be distributed to beneficiaries and are locked in the trust. However, to be able to carry forward the trust losses and offset them against future trust income involves satisfying certain tests under Schedule 2F of the ITAA 36, so as to maintain the integrity of the system. Some trusts, certain accepted trusts, are not subject to trust loss rules at all. Generally, different tests apply to different types of trusts, depending on whether they are fixed, non-fixed, that is discretionary, or family trusts. Different tests will impact upon different trusts. All of the tests apply to non-fixed trusts, which are the most widely used. Fixed trusts only have two of the tests to satisfy, while family trusts must only satisfy the income injection test. Bill, Bob and Peggy are a group of individuals, all of whom control and benefit from two separate discretionary trusts, neither of which is a family trust. The first trust is A Loss Trust, which incurred a loss in the previous year. The other trust is B Income Trust, which is profitable and is expected to continue to derive trust income in the future. A Loss Trust is also a beneficiary of the B Income Trust. During the income year, the trustee of the B Income Trust exercised its discretion to allocate the net income of the income trust to the A Loss Trust. The distributable income of the B Income Trust is not actually paid to the A Loss Trust, but is rather converted into a loan from the A Loss Trust into the B Income Trust. The terms of the loan are not evidenced in writing, and interest is charged well below the market rate. Does the income injection test apply here and deny the recovery of losses in the A Loss Trust? The requirements of Section 270-10(1)(b) are met because under the scheme, the A Loss Trust has derived assessable income because of the allocation of the net income by the B Income Trust. The B Income Trust, the outsider, has provided a benefit to the A Loss Trust by allocating net income to the trust. The A Loss Trust has provided a benefit to the B Income Trust by loaning back an amount equal to its income allocation. The requirements of Section 270-10(1)(c) are also satisfied on the basis that the net income allocation has been made to the A Loss Trust, so that the income tax will not be payable on that net income. However, the B Income Trust has retained use of the income through the low interest loan on terms that are not commercial. Consequently, it appears that the assessable income was derived by the A Loss Trust, and the benefits were provided by the two trusts to each other, wholly or partly because of the prior year loss deductions in the A Loss Trust, and the connection would appear to be more than merely incidental. In this case, the income injection test would operate to increase the net income of the A Loss Trust to equal the amount of the net income allocation from the B Income Trust. Where the test is failed, no deduction would be allowable in the income year against the scheme assessable income, with the result that the net income of the A Loss Trust is increased to equal at least the amount of the scheme assessable income of $800,000. In addition, to the extent that any deduction is incurred in deriving scheme assessable income, the deduction is not allowable. It should also be noted that even if the loan back of the net income allocation was on commercial terms, the scheme could still be subject to the income injection test, as it was more than incidental that by allowing the loss, the B Income Trust would have less income and pay less tax as a result. To recap, in order for a trust to carry forward losses to offset against future income, it will need to pass certain tests. Depending on the type of trust, if a particular test is failed, then the carry forward of losses will be denied.